being here today in this conversation. This is our first, GSA conversation. We are aiming to have this type of chats every month, and welcoming, my venture partner at GSA, Alejandro Vivanco. And today, the idea is to have, chats around pre-seed and for those new aspiring investors. For those that don't know us, we basically are running GSA Ventures. This is a venture capital fund that is raising $2.5 million to support pre-seed startups. Particular in my case, I'm the CEO also of Global Startups, running an accelerator since the last 10 years and working over 340 startups that have passed through the accelerator, two of them that have obtained very, very good results, not because of the accelerator, but because, they were awesome. They got to unicorn level, but we have many other startups that have got, to M&As and some other things. And I have to say, the last year has been a journey for us because it was the first operational year. Is when we started to put checks and looking at startups that were growing in the community. So we cannot miss the next two unicorns that I missed at the beginning. So with Alejandro, we wanted to kind of start a conversation around pre-seed and around investment in this particular area because there is always there are always people that have questions in regards of how to invest in technology. And last year we were kind of running different roundtables, and we were having the pleasure to meet many investors or aspiring investors that not just wanted to work with us, but also wanted to enter into the ecosystem. And that it comes to the first question or the first kind of topic of conversation with Alejandro. And I will first of all asking Alejandro, for those that don't know him, to introduce himself before we enter into that topic. Alejandro, can you give a little bit of the background, your background, to the audience?
Yeah, of course. So welcome everyone. I'm Alejandro Vivanco, a venture partner here at GSA Ventures. I've spent, previously in my career, I worked in capital markets, and then later on for the past couple of years, I've been working closely with early stage startups as a fractional CFO. So really my focus has been on the early stage space, mainly around fintech, B2B SaaS, and biotech companies.
That's great, Alejandro. And Alejandro has worked directly with us almost for the 10 years we have been in operations. So he has been CFO fractional, as he mentioned here, with some of the companies. So Alejandro, you have been a part of this journey with the GSA Ventures, and we have been putting together some educational material for aspiring investors, people that want to understand how to invest in technology, especially in early stages. So one of the most common topics that we always talk with people in general has been around, how to de-risk investment, right? Because people, of course, and especially, under these turbulent times when we see different news coming out, people get really nervous about investment. And of course, this is a long term. But how do you have been addressing those questions in regards to risking investment for those that are new in the technology environment?
Of course. I think there's a couple of different perspectives here. One of them, obviously, the point of diversification. But I think the most important thing to understand, especially when you're getting started in early stage investing, is it's very different from traditional investing, especially, let's say, when you compare this to mutual funds or ETFs that you can trade in the stock market. What makes early stage as an investment attractive for people is that the potential for growth. So the way that you should think about this is not necessarily just to put whatever money you have, let's say 100% of the money that you have in early stage investing. Early stage investing is meant to be complementary to your portfolio, because the way that you have to think about early stage is what is the pool of money that I can set aside and put into companies for the next 10 years, right? You're looking for this long-term impact as well. And that's the first layer. So the second layer, of course, is that, of course, many of these investments are very high risk. So the way to do this is that you do eventually want to spread your risk around either 10 to 20 investments and only commit essentially capital that you can afford to lose. And so the best way to do these 10 to 20 investments is obviously by joining a fund that where your funds are obviously distributed across different types of different companies. You can also join syndicates or angel groups if you want to get started there. So I think we have seen by the through people in the networks and people getting involved in the early stage. There's no straight path to it, but at least be aware of what your options are. Get started, maybe network with people, get to know a little bit more of the space, and slowly integrate yourself into that. It's not something that you can necessarily pick up in 6 months, a year. It's something that takes a while to get good at.
Yeah, no, and that's a really valid point, Alejandro. One thing that we always discuss is that not to do this alone, right? Is what you're saying here. Basically, get a part of groups, not just our groups. There are so many groups in the investment community that can actually guide you and learn from other investors that have been in the market and have done it before. They also have learned how to basically go through the hassles of getting into the right companies. This is the other thing that we always have a conversation in the pre-seed area. Many people, when they are starting, they of course they are looking for the alpha, and they are looking for that a unicorn or that potential company. Canada has or Canadian investors, the ecosystem in general has a famous risk adverse type of environment. So again, tapping a little bit on the risking here and looking for the alpha. Alejandro, what is your best recommendation for investors that are actually looking for startups that can be that potential alpha, or there are some other options that they can look in the market, to kind of make sense of what they are investing right now?
Yeah, I mean that's a very good question. Especially, I think it's top of mind for a lot of investors right now, or people trying to get into pre-seed or early stage investing. Now, so the reality is, let me just give you a couple of stats before, so that it can paint a better picture of what I'm about to say. So the reality, if you look at the data, 50% of VC dollars in 2025 that were deployed in 2025 went to just 1% of companies, right? So that's a lot of money concentrated in a very small pool of companies. So what this means for investors, for every kind of investor, experienced or non-experienced, is that basically easy money, or like the era where you can deploy left and right to any company is over. Right now, I think what you're seeing, the trend that you're seeing with a lot of investors, is that you're essentially competing against everyone for quality deals. So the best way, well, obviously, and especially like the disadvantage, I guess, where there's a lot of people that end up suffering, is that you're competing with people also that have deeper pockets. So an investor that has much more money to allocate is obviously much more attractive to these companies. So then that's how you get filtered out. And obviously, the quality of the network is also super important. So as an investor, especially if you're really interested in early stage investing, I think networks is your first thing that you have to think about. How do I get into the room with the best founders? So I think that's that's how you have to think about it. So for any type of investor, you simply need to be more selective and not less. Just understanding that there's the way to succeed nowadays in early stage investing is going to be by selecting a very small pool of companies and trying to obviously pick the right one, but being very critical and very picky around what you're selecting and why you're deploying, this capital into that specific company. And I think that's where also it doesn't help that for a risk adverse environment, it makes it even more risk averse, right? Because now you add the kind of risk aversiveness to depending maybe with respect to business models or technology. So now you're adding another layer, which is now you making investors even more selective because of uh, the, the, the type of competition that you also have in this space. So it's a tricky one. So in summary, what I would say is make sure that this is why it's also important to join networks of investors, because that's how you allow yourself to, number one, be in the room with potentially the people that will give you access to the deals that you want to be part of. So that's basically number one. And two, get out there, talk to founders, and try to develop your network that way, so that naturally over time these deals come naturally to you as opposed to you trying to look out for them.
Yeah, no, and that's super important. It's very difficult to get, of course, early signs of an alpha. You will have to bet in many companies, but there
Mhm.
is also, a little bit of the thesis that we work with investors that come to our community that is Moneyball, right? And in particular, like you may not get the alpha, but you may get, especially very, very good deals that can give you also a return of investment in a let's say reasonable amount of time at a reasonable amount of a percentage, let's say.
Mhm.
So uh, Alejandro, for those that don't know about Moneyball, can you explain a little bit how it is and why it may be an alternative for those that don't have access necessarily to those type of alphas in the market?
Yeah, I mean, so the Moneyball basically, just to try to explain it in very very simple terms, is looking at characteristics of a company that so well actually so let me backtrack. Moneyball strategy is looking at companies that are overlooked by the market, that people don't pay attention to for whatever reason. Maybe they don't have superstar founders, in terms of like they're not in the magazines and stuff like that. They don't have a lot of media coverage. So the Moneyball strategy essentially focuses on finding people or companies rather that are not necessarily as known but have very good fundamentals. And by fundamentals, I mean they have a very good business model, they have a very good foundation underneath that will allow them to scale, if not as fast, if not faster, as at least as fast as other very popular companies in the marketplace. So the reason why this works is that simply because these companies tend to be, compared again to the rest or companies that are highly sought, they tend to be underpriced. So they have on the long term the same value, but at the same time, currently there's not a lot of competition for them. So the investments dollars are not there, which makes their price much more like a much more appealing entry point. Um, so, given this, I mean, well, I'll stop there because I have other stuff that I wanted to mention, but I'm sure that's maybe part of your next follow up questions.
Yeah, no, it's a very interesting conversation. I think when we saw first time, the thesis around Moneyball, it makes sense for us to be working that, because that's the type of community we have in global startups. Are just overlooked startups that come in a good value. And it makes totally sense. And even though, as I mentioned in the past, we have two companies that reach unicorn level, again, not because of the accelerator, because the quality of the startups. At the beginning, it may be not as obvious that they were getting into that. Now that we have metrics and all that, we can see companies, how they, based on data, how they can actually get into those levels, right? But again, Alejandro, I've seen also like many of these companies that goes to not just Moneyball, just not just Beta's company, let's say in a way. They many times tend to have M&As, right? Acquihires, all that. The last 2 years, as you mentioned, the pre-seed environment has been very rough. Last metrics around M&As and secondary sales have come with, better, let's say, numbers. How do you read the market right now for those particular startups that are overlooked, that are growing in the market? Maybe an opportunity for aspiring investors to actually put money on them based on those type of exits, M&As or secondary sales.
Yeah, I think, I mean, in terms of, yeah, exits, obviously the traditional path, either, towards IPO and so on, maybe it has changed a little bit as well. So the dynamics have definitely shifted. So in terms of, secondaries or acquisitions, you're obviously seeing a lot more of that. I mean, so with respect to essentially early stage funding, I think a lot of companies eventually, they want to generate their exit, or even if they want to keep growing at some point, I think it makes sense for them to, well, not that I think it makes sense for them. They eventually come to the realization that it makes sense for them to join maybe a bigger company to scale faster. So as an example, I think one of the headline news at the end of last week was the $5 billion acquisition of Brex by Capital One, which is one of the biggest banks in the U.S. And Brex was a fintech, basically a forward-thinking startup bank type of thing. And so for them at some point, previously maybe 1-2 years ago, they were valued at $12 billion. But we have to keep in mind that this was paper gains and paper money, and at the private, in the private investor side of things. Now, with this acquisition, basically they had to basically make the choice, right? Do we keep raising? Do we keep growing as a standalone company? Or do we join a bigger entity that will allow us to scale, right? They will give us the right access to technology, the additional, much more greater impact when it comes to maybe the marketing budget. If I'm not mistaken, the founder was saying that now they have a $1 billion marketing budget, to assign to Brex. So these are the type of deals that a lot of investors, will eventually see, I think, over the next couple of years, because as companies, again, because of the money getting concentrated in so very few companies, now those companies themselves, they will have the capital to go out and acquire these companies. And the reason why they will go out and acquire these companies is because it's much easier for them to acquire something that works rather than try to build it themselves in-house. So I think M&A is going to be definitely on the radar for a lot of people in the next couple of years. And so, I think, it's not to say that because the exit path has changed, that your perspective on early stage investing should be.
It's okay. I know you have an alarm now. This happens. Yeah, no, the market certainly has gone really, really, hot or well, it's becoming again hot for M&A, secondary sales, and all that. And it's important to stress out for aspiring investors that there is not just, things about, companies getting into IPO or getting to these unicorn levels for you to get an exit. There are actually many ways for you to exit in the market. And one thing that we do with Alejandro in our, upcoming events and the past events that we have done, with aspiring investors, is to put all this information in kind of simple words. Understanding investment really doesn't require, a lot of knowledge per se. I think in my own sense, what I said to people many times is that before, when I was working with startups, dealing with investors, sometimes I thought the language in the investment world was a little bit challenging for me to understand certain words, certain concepts that I didn't understand at the time. But once it was explained to me, I think, like, it's basically easy for people to understand how investment works. And what is probably a little bit challenging and complex is actually how to deploy those investments. And there is where, Alejandro has been tapping on, getting into, networks, getting into people that know. So you are not doing this alone, and you can, make up your dollars and, getting a return of an investment. Um, we certainly have a lot of information to share in this area, but we also want to mention that we many times have lunch and learn, where we know, I put the QR code there, where people are actually coming and learning about these concepts, through lunch, and to having a candid conversation, with us and with other investors and other people that are entering in the market. So the next lunch and learn that we are going to have is going to be, as you can see here, March 12th. We are located in downtown Toronto, and we deep down actually in all these concepts and understanding how evaluate the startups, deal flow, basically putting all these in easy words so you can understand better what you are aiming to, right? There is also important to know that, we also have, and I'm going to put it here, a newsletter where people can get information about pre-seed and deals. And, whenever, you need information, especially in the ecosystem here in Ontario, in Toronto, where we are located, and you want to understand how pre-seed works, our newsletter goes once a month, and it comes with, the most important topics that affect the pre-seed state in our province, in our country. We sometimes, of course, speak about the global trends because it always affects everyone. But we are certainly looking forward to maybe see everyone in lunch and learn. And, as well, mentioning that, people that are interested in pre-seed, that are interested in learning a little bit more about the community that we have in global startups and the Moneyball strategy, you can also reach us out, through Calendly, just booking an appointment, and we will be happy to having a conversation with you about that. Alejandro, we are reaching out the time here, but I just wanted to ask you if maybe you have any last comments for people that are aspiring to enter into the investment world. Maybe some, we have seen sometimes people actually investing as an angel investor and becoming more interested in venture capital, or, people that are interested in the both worlds. Under the circumstances, we always see news coming on out and in and on, in and out. And I just wanted to know from your perspective, what will be a big takeaway of the current circumstances of the pre-seed, and what do you recommend for people that are looking to invest in technology right now to do?
Yeah, like I said, so I think, I'm going to reiterate some of the things that I had already mentioned earlier, which is, develop your network, know that you have to be extremely selective these days into where you're allocating this capital. And this is a trend across early stage and late stage investing as well. Obviously, I think one of the big points for people is in terms of like what's actually fundable right now, like where should we be putting the money, right? And obviously AI is top of mind for everyone, and everyone wants to, I guess, get on that train, because, and with the right intention as well, because 71% of VC funding in, at least I know that in Q1 2025, went to AI, or machine learning companies. So that's something that we can't ignore. But from that perspective, I think also just to be careful, because not everything necessarily that is AI could be, defensible or tangible. So the question that you should be asking as an investor is not about whether this is this AI or not. That's not how you should be making your investment decisions, but it's really more about, especially these days, around whether the team that you're backing has a real distribution advantage. And by this, I mean, do they have the capabilities to take whatever product they sell, whether it's B2B, B2C, it doesn't matter. The technology doesn't matter. What matters is that, is there a path towards building a business around this, and how are they going to distribute this product? Do they have the right partners in place? Do they have enough experience? Do they have enough knowledge about how they're going to actually enter the market with that given product? So especially given the environment that we're in which now technology in itself is not a barrier anymore. A lot of people can build with AI and much faster. Sales and distribution is extremely important, and if not the most important thing that you should be looking at now, because that's where everyone is competing. So those would be my last few words of wisdom.
Yeah, no, and thank you for those, 2 cents for the market, because again, people have a lot of concerns, and sometimes concerns come from the unknown, right? And not understanding the current circumstances, because you haven't been connected with the market. And you're totally right about the AI kind of wave. Everyone wants to kind of bet on AI, but they don't know how to really look at the good metrics of the company in order to evaluate whether this is going to be a good deal or not. So there's a lot of conversations and a lot of happening in the pre-seed world that we are looking forward to continue sharing and learning along with our investors and our community. So once again, I want to invite everyone that is interested in this world, understanding how venture capital works, and particularly in pre-seed, understanding Moneyball, understanding how to invest in startups, to come and join us on March 12th, so we can, talk over lunch and, speak about, the terminology and how to evaluate the startups, and, many other things that are happening right now in the world in this 2026, pre-seed environment. So Alejandro, thank you so much again for being here today. I bet we are going to continue doing this, for the next month. Maybe inviting some of our LPs and people that are interested to talk in pre-seed as well. So we'll see you next time, guys. Thank you so much for joining us today.
Thank you, everyone.
Okay.